Boa tarde a todos, sou Roberto Atush, CEO da On Research. É uma honra a gente ter aqui mais uma vez o Jay Peloski na nossa live quinzenal. E hoje vamos falar de um tema que é muito importante, que é muito caro para todos nós no Brasil. Vamos falar sobre commodities. Então, acho que o título do relatório do Jay, que a gente está usando como base, ele não deixa mais claro impossível, quer dizer, commodities are the boss. Então, as commodities são realmente na crista da onda agora. A gente viu o que aconteceu com o minério de ferro hoje cedo. Então, eu queria lembrar vocês de dar like no nosso canal, se inscrever no nosso canal no YouTube. Importante, para quem a gente vai estar disclosing um cupom de desconto para quem durante essa live, para quem assinar a plataforma nas próximas 24 horas. Então, deixa eu voltar para inglês. Okay, so now turn back to English. It's an honor to have Jay Peloski with us again. We'll be, talking about something which is very dear and very important to Brazilians, which is commodities. So now I hand over to you, Jay, and tell us what you mean by your title on the musings, saying, commodities are the boss.
Thanks, Roberto, and hi, everyone. Great to be with Ohm Research again. I thought the commodities of the boss was kind of an interesting title. It came to me. It's actually from a Grateful Dead documentary. I don't want to date myself as a classic rocker, but the Grateful Dead documentary, there's a scene in it where the road crew boss is talking about who the boss is and how the boss changes within the Grateful Dead organization. One minute it's Jerry Garcia, the next minute it's Bob Ware. And the road crew guy was talking about sometimes it's even the carburetor on one of the trucks taking the equipment to the next show. Because if the carburetor breaks down, that's the boss, right? Because nothing can happen until that gets fixed. And so it just struck me that commodities finally now, according to Bank of America, pointing their head above positive territory on a one year rolling basis for the first time since 2014. So 7 years. It's been 7 years since commodities are actually up on a rolling 1 year basis, which is an amazing thing. And then JP Morgan points out that among the different asset classes, commodities are actually doing the best year to date, up about 20% on a broad basis. So to me, it's a part of the multi-asset world, the investment world, which many do not really participate in. But increasingly with ETFs and with thematic investing, one can participate in commodities. And I think going forward that it's going to be more and more important, which is good news for Brazil and for Latin American markets more broadly. We've been into that for sure. But I think at this point, it's important to put it out there on the table that I believe we're in the very early stages of what's going to be a multi-year bull market in commodities. And whether it's industrial metals or oil is percolating or food prices or even gold, which has been kind of a disappointing asset this year, even gold is catching a bid, suggests to me that this is a broad-based move in the commodity space. And I think it's going to continue.
Okay, no, so fantastic. Can you when you look at your bullishness on commodities, can you separate what is how much is the global synchronized boom and how much is due to kind of the secular trend, and then we can kind of touch on what's going on the ESG space.
Yeah, that's exactly right. And I think that last bit, Roberto, is really important. But I would say, as you know, and as we've talked about on live shows before, I'm a believer that we're in the early stages of a global economic boom. I think we're going to get the developed market or developed economy reopening here in Q2 and Q3. So the US, as well as Europe, the UK, Australia, Japan, etc., all reopening in the next couple of months. I believe that's going to kick off a period of higher interest rates, and we can get into that. I think that's an important part to talk about. In that higher interest rates are going to set off the second leg of the rotation. So the rotation away from U.S. equities to non-U.S., away from growth to value, to cyclicals, to small caps, away from bonds and to commodities. So that's the overarching kind of framework, right? Global economic boom. And importantly, it's global. So remember, the last time we had a commodity run was in 2012, 2013, 2014, and that was really due almost completely to China, right? China kind of shouldered the burden coming out of the great financial crisis and really stimulated its fixed asset investment program. And that pulled along the rest of the world for a couple of years. Importantly, this time is different. And I say that knowing that whenever you say this time is different, it's always a problem. But sometimes it is, in fact, different. And in this case, I think it is because the demand is going to come from the US, from Europe, and from Asia. So my tripolar world thesis, if you think about the three regions of Asia, Europe, and the Americas, each of these regions is going to drive demand for commodities, and particularly for metals and materials, due to the need to lower carbon emissions, right? So when you think about copper, we think of an iron ore, we think about steel. Here we need to think about copper going into electric vehicles, silver going into solar panels, all the issues around lowering the carbon footprint of the globe is going to drive global commodity demand. And importantly, I think, even extending that further, there's an additional point which I think is really critical, and that's to understand the likelihood that the drive for ESG, which is forcing companies and banks and others to report their footprint, et cetera, in the banking sector and the financing side, importantly, is leading banks to step away from financing energy exploration, mining exploration, and development, okay? So the ability for companies to get financing to expand production of metals and materials is going to be reduced. And that, in turn, is going to run head-on into an increase in the demand for the very same minerals. And I'll give you an illustration. The International Energy Agency, the IEA, recently reported that in order for the world to meet the target of the Paris Accord, demand for lithium, which goes into the batteries which power the electric vehicles, demand for lithium is expected to increase 40 times. Not 40%, 40 times in the next decade or so. Along the same token, another example was in the Financial Times over the weekend. I read that the expectation for new copper supply is only likely to be about 2% over the next couple of years. So of the forecasted mine supply of copper in the next several years from projects that are coming on stream is only going to equate to 2% of that supply. Contrast that with coming out of the great financial crisis in 2012, 2013, that new supply was equal to 12% of total supply. So you can see that there is no solution here because you can't create a copper mine out of thin air and expect it to go on stream and start producing next month. These things take years and years. So the fact that you have demand, which is going to continue to grow aggressively in order to meet all the new carbon targets that every country, every major economy just committed to over the last couple of months, right? Lowering carbon footprints dramatically by 2030. That's going to drive the demand. At the same time, you have ESG pressures on banks to limit financing for said projects. What is going to be the outcome? The outcome is going to be clear. It's going to clear that supply-demand imbalance is going to be priced. So I think it's really fascinating to think about the implications of ESG pressure on bank financing and pressure on metals and mining for demand for these products are going to run head on into each other. And that's what I mean by, I think this is early stage. It's going to be a multi-year bull market in commodities.
Yeah, you know, this is very interesting, and I believe you may also have seen the statements from the CEO of Glencore, where he said last week that you know he would think that copper prices would have to rise by 50% to match supply and demand. So I mean, what you're saying is that the commodity producers that have proper financing today, they are in a very privileged position because no one else can get financing these days because of all of the ESG requirements and everything. So imagine, you are a copper producer. Imagine you're a copper producer and, you have your own, cash flow generating capacity. You don't have to worry about getting new money. You're in a very good position because demand is going to come anyway. And, no one else is going to be able to get money or will get money under much more expensive conditions.
Yeah, and to be honest, I smile, Roberto, because I'm not really sure that cash flow, is sufficient to generate new mining, open new mines. I mean, I remember one of my great trips in Brazil back in the day was to Carajás, the great iron ore mining site, Vale do Rio Doce, and those things are just absolutely tremendous and huge and take years and years. I mean, I think they are. We already have a pretty good idea of what that supply is likely to be in the next couple of years, and that's why I gave that 2% figure. It's pretty minimal relative to the overall supply, and therefore I think you're going to have price having to do the clearing, and then the Glencore guys are obviously much more expert than I am, and I think that whether it's 50% and over 5 years or 10 years, I mean, I think the interesting thing to me, again, and you remember this from when we talked months ago, in the last fall, October, November, I was making the case that you could make money in old energy, in new energy, right? XLE for the oil majors and ICLN for the clean energy. And that worked great. You did, in fact, as an investor, do very well if you were in those two instruments in the second half of last year, in the first month or two of this year. Now, I think the opportunity in front of us is to make money both in kind of clean energy materials and commodities. So think about carbon, which we've talked about here on the live show before. It's been a great investment. I think it continues to be a great investment. And you're going to be able to make money in the old commodities like copper, iron ore, et cetera. So on the clean energy side, carbon and uranium. On the old material side or mining side, copper, iron ore, et cetera. And I think you're going to be able to make money in both. And so for investors, the point is you really need to make sure you have some commodity exposure. And again, the great thing about the ETF space is that it provides vehicles to do exactly that.
Yeah. So, what is your favorite vehicle to play the uranium story? Is it the URA, the uranium, or you prefer to play the miners? I mean, how do you go about the uranium story?
Yes, I mean, I think more important than anything is just having exposure. So it could be URA, which is the big one that folks know the best and is most well known. And then there's also the smaller cap miners, URNM, also very interesting because there you have a lot more leverage to the price and to rising prices. And the way I think about it is that in the US and Europe, the principal issue for emissions is transportation. And so transportation is, you're thinking lithium, you're thinking batteries, you're thinking electric vehicles. And on the Asian side, so again, Europe and the Americas, the two poles focus on transportation emissions. And in Asia, it's much more power generation. And so there, I think you want to look more towards the uranium side. I do expect China is going to move more towards nuclear to offset their coal-fired plants. And Japan, I think, is going to be hard-pressed to not reopen and restart their nuclear program if they have any hope of meeting the new targets that they just committed to for 2030. So again, it's this balance that you can play the clean vehicles, the EV and the batteries on the one side, and uranium on the other side. Carbon itself as a vehicle, KRBN, which I've mentioned before, has very low risk as I see it. Downside risk is very low. Upside opportunity, I think, is considerable because, again, in order to clear the market, in order to drive emissions down, price of carbon has to go up. And so KRBN is a great vehicle to participate in exactly that. Right now, I would say anyone listening right this minute, I'd be a little careful because it's gotten overbought. The RSI is around 75 or so. So probably want to wait a little bit wait for a pullback. But in any kind of thinking 1 to 2 years forward, I would expect that vehicle to continue to do quite well.
Mm-hmm. No, that's great. And just there's a question from the audience, asking about how Brazil can profit from this trade. I mean, of course, you can buy Vale shares, and the other way that and there's other commodity plays, and the other way that this helps Brazil or any economy is through the trickling down effect. I mean, this the currency appreciates. And then you have all of the benefits, like was the case in the 2004, 2011 boom. So it's normally what happens. So and now,
Roberto, if I could just add to that,
sure,
to that question, because it's a great question. Look, I think the real opportunity here is in the laggard markets of the reopening. So the markets that have not participated in that first move to value to non-U.S. markets, and Latin America and Brazil sits right there. And I've talked about being bullish about the real over the last month or two. The real has strengthened and looks like it's going to continue to strengthen. And at the same time, the equity space has absorbed all the bad news, whether it's about the potential for Lula to come back and compete in the presidential elections, whether it's cabinet resignations, whether it's COVID. Again, you have to let the market tell you. And the market is telling you, in the case of Brazil, that it has absorbed all that news, all in the price. And so going forward, the opportunity is for Brazil to kind of recapture the traditional relationship with rising commodity prices. If you look at any kind of historical chart and you chart commodity prices in Brazil, you see in Brazilian equities, you see they have a very close relationship. And our friend John van der Wal, who does some great, puts out some great charts, just showed a chart, I think today on LinkedIn, showing exactly this, that commodities have skyrocketed and Brazilian equities have done nothing. And so I do expect that relationship to kind of come back towards its normal condition. And so to me, one of the things that we did, and I know we're going to get to it in more detail, but we just updated our model portfolio delivery service last week. And one of the things we did was we added to an already existing Latin American equity position via ILF. And ILF offers, it's roughly 60% or so Brazil, but it also offers good exposure to Mexico. And Mexico, too, has absorbed a lot of bad news. And there you see remittances are skyrocketing, confidence is growing, and the Mexican equity market has likewise really done nothing. Same with Peru, same with Chile. So when you look around for equity-related commodity exposure, it really sits in Latin America. And so we've had a situation where all the interest in EM has been in Asia-related tech EM. And now we see that segment rolling over, in part because of the regulatory pressure that China is putting on its big tech companies. And so it's a natural that money is going to come out of Asia a little bit and look for opportunities to play the commodity cycle. And when you look, lo and behold, there's Latin America, and flows have been de minimis. Valuation is very compelling relative to history. And most importantly, that relationship between Brazilian and Latin American equities and commodity prices looks like it's broken. And I don't believe it is broken. I believe it's been obscured by A, the demand for Asian tech, and B, the COVID and political noise that have kind of pressured Latin America and Brazil in particular over the last 6 months or so. So as those two things, one is already in the price, and the move out of Asian tech is happening as we speak. And therefore, to me, again, downside, upside, downside, right? Downside risk in Latin American equities, I think, is very limited. Upside opportunity to play catch up is very significant. Thus, we added to our position.
No, this is very interesting, and I noted that chart with people exiting Asian stocks, and I mean, of course, some of these things are they are mean reverting because EM in the last 10 years have become basically Asian tech, and now because of what you said, investors that were not allocated in LATAM. They were basically allocated, GEM investors were basically under-allocated in LATAM. Now they're beginning to chase performance in LATAM and into a space that has become a lot smaller. So the effect could be huge, when you look at the flows, correct?
Absolutely, 100% right. The activity level has shrunk. The flows have been de minimis. As I noted, StoneX does a real nice job of showing flows in different ETFs. And the two, if you look over the last year in terms of equity flows on a regional basis, the two most undesired, let's say, locations have been Europe and Latin America in terms of flows into the ETFs that represent those two regions. And both of them I happen to like. And so you have a situation where you have commodities are the best performing asset year to date, but yet Brazil and emerging market FX are some of the worst performing assets year to date. So it's just a great opportunity, not necessarily to rotate out of the commodities because they still like the commodities, but participate in the second leg by buying the things that haven't worked yet. And EMFX is just starting to move. I think the dollar is likely to continue to break down here, provides further support for broad commodities in general because they're priced in dollars, as well as support for EMFX. So I think a lot of things are lining up in a very constructive way. At least I hope so, because that's how we're positioned.
No, and before we move on to fixed income, do you have any particular views on Chile? Because people talk about copper, and although the national copper producer is not listed, you've got and Chile because of the crisis and the problems in 2018 and the protesting, it kind of lost a little bit the relationship to copper. But now it started performing well again. So I was just wondering if you have any views on that market.
Not particularly and specifically to Chile, but I do again note the commodity exposure and think that you're exactly right. There's been kind of it's been easy to say I don't want to be in Latin America. Latin America has provided plenty of reasons to not be there, right? Political, COVID, etc. Plenty of reasons. Now, however, again, I go back to the point: it's all in the price. And so the opportunity is, again, on a risk-reward basis, when everyone's looking around and saying, oh, boy, everything's expensive and everything is up at all-time highs. There's plenty of things that are not at all-time highs. And particularly Latin American equities is probably exhibit A for what's not at all-time highs. And therefore, to me, as I said, a big part of my latest monthly, which I put out a week ago. So since the last time we talked, I've been busy. I did the monthly. Springing Forward, which is up on the OHM site. I highly recommend it for people who are interested in what we're talking about here. Go back and read the monthly because that really lays it out. It's 3,000 words and 7 or 8 charts that really go through what we're talking about, as well as the musings on commodities are the boss. But I think Latin America has given people plenty of reasons to not invest. But going forward, it's gonna have a catch up. It's gonna get its day in the sun. And I think it's going to reestablish, at least to some extent, that traditional relationship with commodities. As I said in my monthly, it's time for old school or old style EM. Old style EM being Latin America. When I first started working in Brazil,
that's a good way to say. Yeah.
Latin America was 70% of the EM index, and now it's completely flipped.
Yeah. No. There's a couple of questions here. and it has to do with what we have coming up, which is the fixed income market. So one is about rotation. So I guess you called it very well. You were the first one to talk about rotation, and now you've been saying, okay, don't worry because we have a two growth engine in the market. If you could briefly touch about this, before we move on the schedule. And then we move on to the second question. So just remind the audience of how the two engines would work at this stage.
Yeah, no, I think I've been so very impressed. I started out the monthly actually talking about how the market has pricked bubbles. Right? Everyone talks about bubbles. Everything's a bubble. I completely disagree. I think the market has really done an awesome job of pricking bubbles. Starting off last fall when the FANG stocks peaked relative to the S&P. FANG actually peaked relative to the S&P in September okay, 6 months ago, 7, 8 months ago. Then you went to the whole Robinhood GameStop thing. Remember, I called it a tempest in a teapot. Said it was irrelevant to investments going forward. And then you had the ARK names, right? And then you had crypto. All these have had 30% corrections. You have, look at the SPAC stuff, big correction, 30, 40%. So I believe, and then the last one being the fixed income market, right? When the fixed income, the 10-year priced 0.9%, completely mispriced, and now it's 1.6, 1.7, much better pricing. So what's impressed me is that the market's done all that and still is close to all-time highs, and not only the S&P but globally. So in the S&Ps, roughly 70% of the constituents are above their 200-day moving average, very high percentage relative to history. If you look at the ACWI, All Country World Index, roughly 80% of the countries expressed in the ACWI are above their 200-day moving average. So you have really strong breadth. And that is because you have this twin engine effect, right? When rates go up, that sends a signal to buy value and buy cyclical. So that's one engine. When rates stabilize or come down a little bit, that tells you can go back into growth. So that's another little engine. And so we're playing this back and forth, and the broad market's able to kind of power ahead. I think, as I mentioned, we're about to have the developed market or developed economy reopening. So not just the US, but not just the UK, but Europe and the US and parts, I think, of EM. That's going to lead to another leg of rates drifting higher. And we can talk about rates. I know we're going to do that. And that sets off another leg of the rotation. And my point is that I want to be adding and buying the laggards of that rotation. And that's Latin America. In terms of equities outside of commodities, that is Latin America.
Mm-hmm. No, so that's great. So let's move on to the fixed income market, because, well, number one, you have called it, perfectly. When we talked about this many times, when nobody was seeing the 10-year yield, even 150, and then you said, okay, it's going to go between 175 and 2. And you also called it before that, okay, there was going to be some rates are going to rally a little bit because, there's going to be people searching for yield and everything. So tell us, how do you see the bond market, the rates in the US now, and then we can kind of take it from there and see how that applies to the rest of the space.
Yeah, it's been thank you for all those compliments. You're worrying me though, Roberto, because when you say that I got this right and I got that right, you're setting up the market gods to punish me.
Yeah, raise the bar.
Hopefully they're not listening. One of the things that's really interesting, JP Morgan, one of the great things is that I'm able to kind of look at other research and kind of synthesize that research and put it into my own framework and then deliver it to clients. And so I love to use the brain power of others. And JP Morgan does some really good macro work. And they pointed out that the share of the global fixed income market that is available to private investors has never been lower. Never been lower. This is completely contradictory to what you would think, right? Because there's so much fiscal stimulus. But yet, because of the QE that's going on, the amount of fixed income available to private sector investors to buy has never been lower. I was astounded by that piece of research, and it really made an impression on me because I think it helps explain kind of where we're at in the Treasury market. You've had that move from 0.9 to 1.78. And then, notwithstanding all the hot economic data that came out, whether it's PPI or retail sales or prior to Friday's job number, et cetera, the bond market kind of rallied back to 1.5%. I think we actually went under 1.5 on Friday for a brief minute. And now we're at 1.6 after Friday's jobs miss and today's shenanigans where the market was pretty volatile. So to me, that tells you that, there is a bid. The Treasury market is really the only safe asset that has a positive yield to it, the U.S. Treasury market. That's also something very important to keep in mind. All these investors all around the world looking for a safe asset. The only one with a positive yield is the U.S. Treasury market. And so you have demand, and when you hedge it, the hedged yield for euro-based and yen-based investors is as high as it's been in years. And so this helps explain why there is a bid for treasuries around these levels. And now I think it's going to be interesting to see where we go from here. To me, I think it's interesting to contemplate the following. You have, on the one hand, what we spent the first 10 or 15 minutes talking about, physical price pressures in the commodity space, right? You have, on the other hand, the digitalization of everything. So to me, what's really interesting is how do these two forces, who's going to win? Who's going to be the boss of the fight between digitalization of everything and physical commodity price pressure? I think it's going to be the digitalization of everything because it's so much broad, right? We're not going back to the 70s, like when oil prices shot up and inflation ensued. That's not at all what we're going into because we have digitalization of everything, you know, firing ahead at COVID speed, spreading across the entire global economy. And so to me, I'm a believer, continue to believe, as we've talked about for months and months, transitory inflation. We're going to see it on Wednesday, right? Wednesday CPI, the forecast number is 3.6%. It will be the highest headline inflation number in years. I hesitate to think that's not already in the price. We've talked about how COVID speed has accelerated the discounting mechanism in the markets. So clearly it should already be in the price. But I think the testing time for fixed income is going to come much more later in the summer. Because I think the issue is not all these crazy numbers that we're seeing, you know, all around the world in terms of economic statistics. I think the testing ground is going to be when data normalizes and investors can see whether or not all this spending has propelled us onto a new growth path, a higher growth path, more equitable, sustainable, good for the climate growth path, or do we go back to kind of the subpar growth that we saw in the decade between 2010 and 2020, which was like 2% developed economy growth. And so to me, that's really going to be the testing ground when you have clean inflation numbers, which will be like, let's call it the June or July inflation prints in the US. That's right around when you're going to have Jackson Hole and the Fed talking in August. That's when you have thin markets, people on vacation. That's when you have poor seasonality. So to me, that's really probably where we're going to get the testing ground. And I continue to think that the 10-year U.S. Treasury is going to gradually drift higher. I think we want it to, because if it doesn't, then that's going to suggest that we aren't going to get that higher growth path. And all we have done is just put on a tremendous amount of debt for nothing more than a filling in the hole, so to speak. And we're back to kind of flat when we come out in the third and fourth quarter. So that's really where I think investors should look in terms of thinking about the testing time for treasuries and then for what that means for other assets. In the interim, I think what's going to happen, you are going to have inflation prints higher. That means, and I think it's clearly telling us that the nominal rate of 10-year treasury is probably going to stay around these levels, right? 1.6, 1.8, somewhere in there. And therefore, real yields are going to go down, right? Considerably, because inflation's going up, nominal rates stay the same, real yields go down. That's good for gold, and you see gold catching a bid. That's bad for the dollar, which means it should be good for broad commodities, should be good for EMFX, should be good for non-US equities. And the interesting thing is going to be what happens to the growth stocks, because here on a day like today, it looked like death. It looked horrible.
Yeah, no, and that's what I was going to ask. It's been a couple of wild days, so I was going to ask first, if you had, if you could give us your take on the payroll and what was the market reaction, and then it kind of saw it as kind of a Goldilocks scenario, and then there was this wild ride with the tax. So on Friday, it was like bad news is good news, but then today, I don't know if people were spooked by iron ore going up by 10% on some very specific issue related to China. But now the market thinks, okay, what commodities are telling us is very bad for tech, which wasn't so much the case on Friday.
Yeah, no, I think it's, reading too much into the day-to-day is probably not a great, recipe for health and longevity. So probably try not to do that, not read too much into any one day's trading. But I would say first off on the payroll number, clearly a big miss. I really hesitate to ascribe it to people super happy to get an extra $300 a week and therefore they don't want to work. $300 a week in unemployment insurance, an extra $300 is $1,200 a month. So that's $12 grand a year. I don't think people are staying at home for $12,000 extra a year. And to buttress that point is the fact that leisure and hospitality added 300,000 jobs last month, and those are typically the low-paying jobs. So I think that the whole argument that it's people not wanting to work, I think is just not valid. I think in places like New York, for example, where you hear about restaurants not able to get employees, yes. And the reason is very simple. Most of those jobs were probably held by non-resident immigrants, right? And who left because they couldn't hang out for a year because they couldn't get any benefits because they weren't quote unquote legal. Yeah. So to me, that also makes perfect sense. And so if you're going to have to pay people more to do those kind of jobs, that's great, because that is what we're supposedly driving towards, because we're driving towards a more equal society. And part of the issue is that if you can't, the federal minimum wage in the United States, everybody hears about $15 an hour. The federal minimum wage is $7 and change. Hasn't been adjusted in decades. Okay, that's just ridiculous. So it needs to, and so since the government can't change it because of political, fighting, then the private sector is changing it. So you see Chipotle and others say they're going to pay $15 an hour to get people to work. That's great. Now, maybe you have to pay another extra 10 cents for your burger or whatever you get at Chipotle, but I don't really think that's going to be the end of the world. So to me, I don't want to read too much into any one day of trading. Also don't want to read too much, particularly in this uncertain period of one data point. I do expect the U.S. economy to continue to power ahead. I do expect job gains to continue. The one thing I would note that you did have average hourly earnings up considerably more than people expected. Again, I think that's partly because you had most of the jobs coming from that low wage segment, which is paying a little bit more. But that's something we can watch. And, the bond market took it fine, basically said, I'm going to look through this, right? Because the bond market rallied, from 1.6 to 1.49, then back to 1.6 today. Basically flat, up a basis point or two, nothing meaningful, 1.6. So the jobs number, a little bit of a surprise, but I'm not reading too much into it. Continue to see the economy powering ahead. Today's action in the market, interesting. As I mentioned, the tech stocks, the growth stocks, the thematic growth segment, the ARC names, et cetera, really got pounded, down 5%. Crypto was just totally all over the place. I took a look at Ethereum. One of the Ethereum ETFs had a 40% swing just today, 40% in one day. So, that's, that's crazy. You can't really deal with that volatility professionally. So all that does is probably suggest that for any institution that's thinking of broadening out beyond Bitcoin, Ethereum may be a little bit too much, because you're not going to be able to stomach a 40% intraday move in your positions within a portfolio, at least not for very long. So I think that those the tech stuff doesn't act well. I think it does reflect a view that the economy is going to continue to strengthen, that you are going to have higher rates gradually, and people just basically more even than higher rates. I think people are just reallocating. There's been so much money put into growth stocks in the U.S. over the last 10 years. It's been a 10-year run. And this is what I'm saying about value in the early innings, commodities just at the very beginning. Because these relationships got so extended that you're going to have these periods where you're going to see data activity be ugly because it's all sellers and no buyers. And now that most of these vehicles have broken their 200-day moving average, technically they're weak. There's not a lot of support underneath them. And because they are kind of thematic and therefore don't have a lot of opportunity to kind of tether or hold to any one particular kind of data point, right? It makes it hard to say, okay, I'm going to put a foot down or stick a fork here and I'm going to buy here. And so to me, those particular things continue to look unappealing. The tech names, the FANG names, fantastic earnings, and they've done nothing but go down ever since. So that tells you, again, it's all in the price in terms of the good news, right? The work from home, all that's fully in the price. And now people are recognizing that for a while the growth is going to be elsewhere. And people are not invested in that elsewhere. And so they're selling some of that because they have gains, even down 20%, still have big gains in some of these names, and rotating into the things like Latin America. ILF was up today. Some of the commodity space was up today after the big move it's already had, big move in kind of like very tight time frame. So to me, that's kind of episodic of what we've been seeing, and it's probably too early to go back into those big tech names because I think they're going to continue to be weak on a relative basis. And again, not crash, as we've talked about before. If the U.S. crashes, then everything goes down.
Yeah.
What we want to see for the rotation is for the U.S. to be a relative underperformer. And it will be a relative underperformer driven by the heavy weight of tech, which itself is going to be a relative underperformer, but not crash, because these are particularly the FANGs, super cash-rich, cash-generating machines, as we saw in the last quarter, with significant amounts of money to buy back stock, to pay dividends, et cetera. And they will use that cash to do exactly that. So it's a relative performance game, not an absolute crash scenario. I think anyone who's saying that this is like 2000 and the tech space is just completely wrong.
No, I agree. And before we move on to your portfolio changes, just one thing about employment, because some people are suggesting that the Fed may, people look at the unemployment rate today may be a bit misleading, and people suggest that the Fed may want to increase the participation rate. And if you go back to the highs of the Clinton days, back to 1999. You would talk about, like a 12% growth in employment. So, it's a lot of jobs. And to what extent this is true? And to what extent do you think this is achievable? I mean, are really, some of those, some of the participation is gone. You think some of that can be increased again? Is that something you take a view on?
Not directly, to be honest. I haven't really thought deeply about that. I think from my point of view, the longer we have kind of the Fed on hold, the better for risk assets. And so if I'm a believer, as I am, in a multi-year economic boom globally, and if I'm a believer that the Fed is going to be patient and will wait until the data points it has already laid out get achieved. What's good about the environment now is that it takes the market pressure off the Fed, right? Because it's the bond vigilantes and the taper crowd who was trying to move all that stuff up until this year, even talking about raising rates this year. Excuse me, which I think is way far from reality or from any likelihood. Mm-hmm. But that was starting to get priced into the market. And so I think what a job number like last Friday does is it puts all that on hold. Now, again, we're going to see the CPI on Wednesday. 3.6 is the consensus. Who knows? Maybe it may even hit 4. If it hits 4%, then you're probably going to get all sorts of commentary. And then you have jobs number again in a couple of weeks. I think we're in a process. We're in a reopening unlike anything that we've seen. And therefore, we have to kind of respect that process is going to give you some head fakes. And in the intervening period, you want to make sure your portfolio is structured in a way that allows you to participate. You're not too far into one side or the other, which is, certainly with the thematic space is definitely a challenge. Is, how do you size and position within a global multi-asset portfolio? And so, you do have equities, you do have bonds, you do have commodities, you do have thematics. And so across that space, the objective obviously is to have a point of view as to where you're going, and then have a portfolio that reflects that view and is not too top heavy on either side, and therefore can ride through some volatility. Again, as we talked about, pothole markets, right? Today was a perfect example of a pothole, right? You're driving down the road this morning, things were great. Driving down the road, everything's fine. And boom, around 1 o'clock this afternoon, 1:30, 2 o'clock, the market hit a pothole and everything just sold off aggressively. So, we'll see. Those are days when hopefully you can be a buyer and not a seller. If that's the case, then you can look to participate in certain things. But from our point of view, a global multi-asset portfolio with a good exposure to commodities, to thematics, to equities, and limited exposure to fixed income is how we want to be positioned.
So that's great. So why don't we go on to your portfolio changes? So I've noticed you have done some changes, so increases some weights. So it would be great, to hear what you're suggesting.
Sure. I mean, I'll go through it kind of in broad brush because, again, the clients who pay for the model portfolio delivery really are the ones who get the specifics. But certainly to talk about it, we do, our process is a 3-step process. So first, I write the monthly, which allows me to kind of collect all my thinking and make it current and updated. And so I do that, and that comes out at the end of every month. And then I go right into portfolio review right at the beginning of that following week, which was last week. And then I deliver the model portfolio to clients, and we have a one-on-one conversation soon thereafter. So that was last week's activity. We cut the portfolio on Tuesday and made changes. And basically the changes were to reduce and exit some of the broad-based thematic names that we had in the portfolio in order to provide space to bring in some more commodity exposure, as well as some regional laggards, as we've touched on already. So kind of took down the broad thematic names and added to commodity-based thematic names in some of the spaces that we talked about: electric vehicles, uranium, nuclear power, etc. So some of those positions were enhanced. We basically took our commodity position up by about 40%. And so now if you look broadly, so if you include things like the metal and miners or the energy names and things like XLE, we have probably close to 20% of the portfolio in thematics, both debt and equity. So the things we did, for example, is we add to the pipeline space in the U.S., very high yield, protected by rising oil prices. Goldman, JP Morgan, others have anywhere from $75 to $80, $85 barrel oil here in the second half of the year. So that pipeline space we think is really interesting and provides an opportunity, really good risk reward with a very juicy high single-digit yield. So that was a position we increased. And then, as I mentioned, we also expanded our position in Latin American equity considerably. So it's now one of the larger positions in the equity space that we have. Very bullish. As I said, I like the risk reward. I see very limited downside risk. I see considerable upside opportunity for those equities to kind of come back towards the commodity relationship that they've had historically. So in essence, we slightly reduced our U.S. equity holding. We went more overweight with that Latin American ad, more overweight the non-U.S. equity markets. We took down the thematic a little bit, but basically rearranged within it away from kind of the broad brush, open-ended growth and more towards commodity mining specific thematic plays, as we already have discussed at some length, so I won't belabor that. We added to the pipeline, as I mentioned, and I'm just quickly taking a look down. The other thing we did was we did kind of shift away from emerging market tech a little bit. That has been a space that I've been very keen on, and we added to a China health ETF. Basically, the idea being that I'm convinced that the regulatory pressure that the Chinese big cap tech names are under is likely to be sustained. If you go back and look at history, the last decade or so, in these types of campaigns, they tend to last a year or two. So we wanted to reduce exposure there, but participate in high growth areas within China. And one of the high growth areas is in the health sector. So we kind of did a switch there as well. So at this point, when I look at the portfolio, we have about 25, 26 names, give or take. We're well diversified between equity, fixed income, commodity, and thematic. Thematic is about 21, 22% of the portfolio. Again, itself within the thematic, much more tied towards kind of some commodity type plays, whether it be carbon, whether it be uranium, whether it be lithium, as well as the other traditional things we've talked about, like infrastructure and reopening with the airlines, continue to hold those. So we didn't make a tremendous amount of change, but where we did, I think, is we got closer to the commodity space and expanded and grew the commodity space, which, as I said, I think is very, very compelling. So that was it in a nutshell. And we're running pretty fully invested. So in terms of cash, very little in the way of cash at this point.
That's fantastic. And I'm always tempted to ask your view on the dollar. And we were kind of discussing this before we went online, and it was very interesting because the dollar has been sideways since the January election surprise, when the Dems took control of the Senate, and then that's what kind of brought forward the by, let's say, a year or so this inflation debate. And then I remember discussing maybe 2 or 3 sessions ago when you said that the dollar was a little bit tired when it tried to break above the resistance of 92 and change, and
Yep.
actually touched 93 DXY. Now it's looking like it's trying to push downwards. And is that a view you share? Because on Friday the movement was very dramatic. The DXY was down by almost 1%. Same thing today. Do you think that if we have a benign inflation inflation number on Wednesday, do you think that there's going to be nothing in the way of preventing the dollar to go to break through 88.6, which is the next big level?
Well, I think it's at what, 90.2 right now in DXY. So 88, yeah. 88's a pretty good sized move down. Look, I continue to ground it as I do all my asset views in kind of my macro framework, which in this particular instance, I would talk about the divergences. And, we've talked about this before, right? The divergences between the US and Europe, whether it be growth related or COVID related, right? Those divergences, I've argued, are at their wides right now. In other words, the Europe in recession in Q1, US growing, US COVID vaccination process successfully being rolled out, Europe still a mess. We've already passed the wides. We're now narrowing, I believe. If you look at some of the data coming out of Europe, for example, investor confidence data came out today, was the best it's been in 3 years. If you look at European earnings, fantastic. European earnings, forget about GDP. Earnings are what drives stocks. And earnings in Europe were up 48% year on year, roughly in line with the US.
Even the banks are having good earnings.
Yes, the banks are, still, as one of my favorites, still cheap on a relative basis. Not to disparage the Brazilian bankers who I love and know well, but if you look at what Itaú sells at on a price to book basis and you compare it to any European bank, it's probably 3 times more expensive than the European banks on average. So yeah, the banks are still very cheap. But to get back on point, the divergences are at their wides. The U.S. dollar has benefited from this exceptionalism, right? U.S. fiscal stimulus, bigger than almost any other major economy. COVID vaccination process rolling out pretty aggressively and successfully. So that exceptionalism argument supported the dollar. And now, though, it's becoming less exceptional because others are coming along behind it. And the other thing to think about is just a quick aside on Europe, at Europe's growth 2022, and we're not that far away from thinking about 2022 as investors. Europe's growth in 2022 could be better than the U.S. because of the delay in releasing the joint recovery fund money, which still hasn't even started yet, whereas the U.S. has already basically powered in the vast bulk of the fiscal stimulus it's going to provide. So exceptionalism gives way to the price, and the price is the twin deficits, right? Twin deficits, huge current account deficit in the U.S., huge budget deficit that has to be paid for in some ways, and you either raise rates or weaken the dollar. Those are the two ways. And rates may go up a little bit, but they're not going to go up dramatically, I don't expect. And so therefore, the dollar is the natural fallout. And I think that's kind of what you're seeing already start to play out. And as people continue to move in that direction, EMFX, big laggard, big opportunity. I continue to like EMLC in terms of local currency debt. Hasn't really worked all that well, but continue to think it's got pretty good upside from here. And so to me, the dollar, further dollar weakness is likely. It will support the commodity move. It will assist the emerging markets and reinforce that laggard opportunity. So when you think about the laggard play and you think about the commodity play, you know, a weak dollar is definitely a help. And if the dollar was going to strengthen, in my view, it would have already done so. So the fact that it was not able to break above and is now rolling over suggests to me that 88, or even I've seen some numbers now starting to talk about 85 on DXY is probably something to think about. And then the last point, it actually reminded me when we talked about European earnings. I would also mention that you're starting to already see, you know, very significant earnings revisions up in the U.S. and in Europe in particular. And for 2022, starting to see estimates for the S&P of $225, $215, $250 is the highest number I've seen to date. But just to take that 250 number and agree, and again, it's on the high end, but $250 earnings in 2022, and you divide the S&P at 4,200, call it today, that puts the S&P on next year's earnings at less than 17 times earnings. Yeah. So again, it kind of argues against this mindset in the headlines about bubble this and bubble that. You know, a market that is at 17 times next year's earnings is not in a bubble.
No, exactly. And as we discussed the other day, I mean, I think the market knows everything that there is to know. So it's not like, I mean, the market doesn't know all of these things that we're talking about. And it's not like, you know, as you say, you know, we should listen to the market and not, you know, tell them, you know, and not be pretentious, you know, to tell the market, you know, what we think. So you always have to be respectful.
Yeah, 100%.
Yeah. And one thing, you know, I tell you know, being in Europe, finally, I mean, for a few weeks now, but in a couple of weeks, life is is getting back to normal. So, I mean, Italy is almost fully open. You know, you don't have nightclubs open, but, you know, the restaurants are open with some flexibility to indoor dining. There's still the curfew, but they're going to do away with it. In Germany and Spain, they don't have the curfew anymore. So I think, you know, there will be the feel-good effect is going to be significant in a few weeks' time. So I guess, you know, that you know, translates into significant, you know, improvement in the overall mood, I would say.
Yeah, and just to pick up on that, you know, one point about the banks, which we didn't mention, is that, and I know I've mentioned it to you before, I continue to think you could see the 10-year Bund trade with zero or even a positive number on it this year, and that will be very, very constructive for for the European banks. Right now, I think the 10-year Bund is at minus 0.2%. It was minus 0.8% early this year. It's already had a huge move, but I think that will continue, particularly as you get to the reopening. And Europe is well positioned. The manufacturing side is doing very well, as we know. The service side is what's coming, and that investor confidence number I mentioned, the best in 3 years. So going back to March 2018 was the last time investor confidence number this in Europe. That service sector reopening that you're talking about in Italy is going to really be constructive, again, for some of the reopening trades, for the airlines, for the banks, for Europe more broadly, which is a cyclical market in terms of its makeup. So I continue to think that Europe, though it has performed quite well, still has an awfully long way to go in terms of relative performance, relative valuation. Morgan Stanley pointed out this week that on a relative valuation basis, the discount of Europe trading to the rest of the world is still close to an all-time wide discount, even with having had decent performance up 10 or 11% year to date. So I think Europe, we didn't make any changes. We continue to be overweight, continue to like the banks, continue to like broad Europe, and think that that market has continued upside.
Fantastic. So yeah, that's great. So again, I want to thank you, Jay, and it's been wonderful. We just passed the hour mark, and look forward again to our next session in 2 weeks' time. I think it's going to be the 24th of May, and in the meantime, we'll publish the next musings, and we'll always be in touch. If there's anything coming up, I'll let you know. So thank you again. I'll turn to a few comments in Portuguese now, and then I'll turn back to you for your final remarks. Mas obrigado a todos, obrigado mais uma vez. Queria lembrar vocês, para quem participou, que tem o nosso cupom de desconto, lembrar de se inscrever no nosso canal. So now I turn back over to you, Jay.
Yep, thanks, Roberto. Always great. I mean, telling you, these hours fly by. I don't know what it is, but you have so much to talk about, and you ask such good questions that the time really does fly by. Hopefully, the audience finds it useful. Again, if people are interested, I encourage you to go back and read the monthly from a week or so ago up on the OHM site, and continue to look forward to speaking with people. And to if folks are interested, our model delivery service, please reach out, and I'd love to engage with you on that basis. So thanks again, Roberto.
Thank you, Jay. Thanks, everyone. Bye-bye.